Hello everyone, I'd like to welcome you to today's webinar, Tax-Focused Financial Planning. This webinar will be presented by Troy Thompson of Thompson Advisory Services. Please note that due to the high volume of attendees on today's webinar, you will be muted for the duration of the webinar. You're welcome to submit questions throughout the webinar using the chat box on the bottom right, and these will be addressed at the end. I would like to remind everyone that in order to qualify for CE credit, you must be online for the duration of the webinar. Over to you, Troy.
Well, welcome everybody. I'm Troy Thompson. I'm going to talk to you today about Advisor Tax Alpha, how and why to add measurable value with tax-focused financial planning. And I'm going to spend a lot of time on the why today and a little bit of time on the how. And then we'll have time for questions at the end, as Rebecca says. Before we begin, I want to recommend to you a white paper produced by my colleagues Jonathan Heller and Robert Walsh called Tax Alpha, How to Add Measurable Value with Tax-Focused Financial Planning. You can email ACP when we're done with this webinar to request a copy of that white paper. It's a terrific piece of work and very carefully done and is sort of the inspiration and the background construct for this presentation. We're going to focus on two things today, two main areas. Number one, why tax-focused planning is essential to your practice. And number two, how are you going to integrate tax services into the financial planning engagement? All right, let's start off with why. There's a few big reasons why. The biggest reason why is internal. Your practice, all of our practices, face serious and significant challenges. Number two, your clients need your help. They really do. And I'm going to talk to you about the reasons why they're not being particularly well served the way that tax preparation and tax planning services are delivered to them right now. And number three, when you do this, it allows you to practice financial planning, to do what you're already doing now, only do it better. All right, what are these challenges that I'm speaking about? The first challenge is really differentiation. And for new practices and also for mature practices, we're constantly hearing that one of the biggest jobs we have to do is to differentiate ourselves from the competition. Whether it's to find some sort of niche market, doctors and dentists, professors, whether we're promoting our fee-only approach, fiduciary approach, whether promoting particular kinds of investment products or investment strategies, or some other form of specialization. Differentiation is a key challenge, and tax preparation services and tax planning services are a very powerful differentiator. Second challenge that we face, and this is related, fee compression. You know, as we look at the development of our profession over time, we see a progression from sales to investment advice to comprehensive planning, and that development also comes with the commoditization of investment advice and fee compression. There's a lot of pressure in all of our business models to add value and to show the value of the financial planning engagement. And tax planning and tax preparation services can really help to add value. Number three, retention. Almost all of our business models depend on retention of existing clients. Very few successful planning practices renew their client bases every single year. Even hourly planning requires a sort of a repeat client base to succeed and grow. Tax planning and tax preparation services provide multiple high-quality touches throughout the year, year-round visibility and mind share, and stickiness, the real impulse for your clients to stick with you year after year because they see the value of what you're providing. And And then finally, I think of at least minimal tax integration in the financial planning process as key to the fiduciary role that we play with our clients. Now, right now, the regulatory definition of fiduciary is in disarray, and it's not exactly clear what, from a legal point of view, the fiduciary standard will require of our practices in the future. But if you strip away the technicalities, I think at the heart of what fiduciary standard requires of us is that we take responsibility for meeting our clients' needs. And tax needs are central to our clients' financial planning challenges. And as I'm going to point out, they're just not adequately met unless we are involved. The conventional approach to dealing with taxes in our clients' lives falls short. It's not serving them well. Most financial services that provide tax preparation services in this country are high volume, low contact, low fee services. I often remark to our clients that the difference between what you would typically get in a retail tax preparation engagement and TurboTax or similar products can be hard to justify depending on the way that the clients engage the services. We think that planning within the context of a comprehensive planning engagement is much more valuable to the client, and that we're in the best position to provide that. Let me talk about what I mean about the conventional preparation approach. It's backwards looking. It looks at events that have already happened and records them on an annual return. It's reactive. It responds to events that are in the past and creates immediate tax season solutions to those problems. It focuses on the cash flow at the time the return is filed. Am I getting a refund? Or do I have to pay money? How much money? And it's static. That is to say, we begin with last year's return, we fill in the blanks, and we file the return. The focus is on compliance and correctness, but not on other factors. It neglects client education. And this, I think, is one of the most important points that I'll make today. Taxes are complicated. Financial planning is complicated. We're dealing with a complex system of rules that affects the way that clients experience outcomes. And our job is to help our clients understand that system of rules so that they can modify their behaviors and conform their decisions to the outcomes that they seek. There's no way that we can catch it all once a year looking at the tax return. And we need our clients to be engaged in the process. And finally, there's no forward planning. When we interview our clients, our new clients, about their prior tax return experience, very few of them report that they've ever had a meeting with their tax preparer outside of the preparation itself, or that they've engaged in any mid-year or during the year forward planning surrounding their taxes. And that's what financial planners set out to do, and that's why we think that an integrated approach is more suitable. It's anticipatory, it is active, and it is dynamic with respect to client tax problems. We give our clients ongoing attention throughout the year on a variety of topics, and we're able to fold in the tax aspects of those topics as we work with clients. We focus on client education so that they're in a position to spot opportunities as they arise, and also they're in a position to understand and appreciate what motivates the advice that we're giving them. It uncovers opportunities rather than reacts afterwards. If clients of ours had very simple tax postures, this might not be so important. But the fact is that our clients and yours engage in remarkably complex activity, surprisingly complex. I think I've never had a new client come in and sit down with us and say, I've got a really complicated tax return. You're going to need to spend time with this. Everybody thinks that their taxes are simple until you start digging in. Here's some examples. Real estate is probably the most common and one of the most vexing examples. It is often done correctly, but it is often done incorrectly on the returns that we review. I'll give you a little anecdote about the very first client that signed on with me. They were a couple that had moved into one of the houses that they owned and held the other for a rental. They had had it for about 5 years, and no one ever told them that they were supposed to depreciate the rental property. So that when they came to me and I reviewed their returns, it was immediately evident that they needed to make a change. And that single change, which might not seem like that big of an act as a planner, paid for my first 3 years of fee and subsidized really the entire rest of the relationship. So the first point I think to make is that these complexities drive errors that are more common than you think. We're seeing more and more short-term rental arrangements through the popularity of Airbnb and similar technology, so that clients who were never before engaged in short-term rental arrangements are suddenly plunged into a much more complex activity from a tax point of view. And there are also opportunities that are presented with those short-term rental arrangements that are not well understood, we're finding, by the general population. Clients who have their own business, who are freelancers, have enormous opportunities for tax planning, both in the business deductions and in the retirement plan creativity that we can really help and engage with. Our clients either inherit money or they're beneficiaries or trustees of trusts. They either need planning and preparation in association with their trustee role, or they're beneficiaries receiving K-1s that make their planning particularly challenging or difficult. Clients receive stock compensation, restricted stock or restricted stock units, various flavors of options, employee stock ownership plans, ESPPs. All of these add not just tax reporting complexity, but planning complexity that overlaps and blends with our investment advice and other forms of financial planning advice that we engage in. And I haven't even mentioned the kind of exotic things like master limited partnerships, oil and gas, timber, private equity that we don't necessarily encourage, but we do see from time to time and add their own brand of complexity. So I've listed a number of examples here. My practice is not unusual. These are kinds of issues that are discussed on the ACP forums on a weekly basis, and I'm sure many of your clients are engaged in the same sorts of activities. So even though clients don't realize it, they are engaged in complex activity because the world is complicated and the way that they're compensated is complicated, and the investment decisions and the property ownership decisions that they make are complex. Maybe even more important as a hook for people considering whether and how to integrate taxes more closely into their planning practices. Prospects are actively looking for this. We actively, to the extent we actively market at all, we on our website present ourselves as tax-focused financial planners, and I have tax credentials. I was a practicing tax attorney for a decade, and so when clients are considering their options, they're actively seeking tax integration. I would say 60 to 70% of the new inquiries that we get when we ask clients why they're interested in pursuing financial planning, not why they picked us, but why they're interested in financial planning, 60 to 70% of them say one of the main reasons is that they need more help with their taxes and integrating taxes into their planning. So now I want to talk about a slightly different aspect of this problem. We understand that clients need our help, but we're financial planners, and we do a lot of things for clients. And I want to talk to you for a few minutes right now about how integrating taxes into your approach will help you do what you do now better. In other words, we believe that every aspect of financial planning is linked to other aspects of financial planning, and that it's hard to do a good job at any one area without mastering all of them. And taxes are central to that. So let's talk about prospecting. When a client wants to come talk with us about engaging us for financial planning, we always ask for them for a series of 3 years of recent tax returns. And the reason we do that is because we think it helps us to more easily qualify the client, gain insight into their situation, identify problem areas, and demonstrate our own competence. One of the biggest challenges that we face dealing with clients is information exchange. We love them, but clients are simply not reliable when it comes to reporting the detail of their financial lives. And for the same reason that we always want to get asset statements and not hand-built spreadsheets so that we can see what's really going on, we want to look at the tax returns. It's a complete and standardized data set that with some experience you can quickly use to evaluate the client's situation. You can identify problem areas that you can use in your discussions with the client to uncover the issues that they're facing. Issues like obvious issues on the Schedule D would include excessive trading or trading that over a series of years just doesn't make sense. You can use it to identify what we call stale equity compensation. Clients who are receiving, for example, restricted stock or RSUs over a series of years, and it's clear that it's from the tax return that it's being reported in their income, but we don't see any asset sales, so that position is building up. We can examine the treatment of rental real estate, which I've already mentioned. We can help clients look at business performance. So not just whether it's presented correctly on the return, but whether the business or the rental activity that they're engaged in makes any sense from a return point of view. All of that information is available to us. We learn a lot about family relationships. We learn a lot about leverage on real estate and other areas that are central to the planning activity that we're about to engage in, and to the presentation and the sales activity that we're about to engage in with the client. And then this last point about demonstrating competence, I think is really important. It can be very difficult for planners in an initial encounter to bridge the gap of skepticism that clients bring. They may have been referred to you. You may have a number of years of experience. You may have credentials. There's certainly a reason why they're in your office and ready to talk to you. But it's hard in an hour or a 90-minute session to really demonstrate competence. And we think that using the tax return is a great tool for overcoming some of those barriers. When I was trained as a lawyer, one of my mentors told me that when you meet with a new client, the first job is to get the papers and to get all of them. And he said, not only is that because you need the real details, the actual data, but he said there's a symbolic enactment of an advisory relationship. When a client hands you important papers, you become responsible for solving those problems and for assisting that client. I think it's a really powerful way to gain trust in that initial encounter. So once we have been engaged and we're engaged in the financial planning process, what are some areas that you're already doing that you might think have nothing to do with tax that you can improve your service to your clients by integrating taxes into your program? So the first one is cash flow. You already know, for example, that if you see a client with a revolving credit problem, you've diagnosed an issue that you can address using financial planning tools. It might be an income problem, it might be a spending problem, it might be a cash flow problem throughout the year. We find with our clients that many times when we find that there are cash flow challenges, they're related to mismanagement of tax issues. Either because tax withholding and estimated payments are not being managed appropriately, and this is common because clients simply don't understand the way that they're being compensated using non-cash compensation. They're either hoarding stock and options in ways that they don't realize are creating taxable income for them, or they're failing to realize income that they have and need because they're refusing to exercise or access their stock compensation. So cash flow problems we find can be addressed very effectively by helping clients to manage those tax-related issues. Retirement planning, this is an obvious one and everybody struggles with it, but what will their tax rate be in retirement? Well, we don't know what the tax rate structure will be, but we have tools that will allow us to understand how clients' tax situations will change during different phases of their lives. We can model the way that projected RMDs affect their tax picture. We can model the way that their different sources of income in retirement will be taxed. We can understand what it might cost clients in particular situations to realize capital gains, whether Roth or IRA type contributions make sense each year, or whether Roth conversions are appropriate. Are there any additional opportunities from year to year that we can identify simply by paying more attention to the tax picture? Here's just one more real-life example from an experience that I had several years ago, having to do with integrating tax planning into the financial plan. It was a very unfortunate situation. My client suffered on the loss. She had a loss of, I think it was $400,000 or $500,000 in what amounted to just outright theft by a financial advisor of hers, a relative who just absconded with the money. So here she is with a gigantic ordinary loss and really very little income to speak of. She was retired, she was single, she had a modest pension and Social Security, very little withdrawals from the IRAs because she wasn't yet 70 years old. These losses in her situation were just going to carry over for about 5 years without any opportunity to use them. And that's a unique situation. We helped her with a Roth conversion that not only reduced her future RMDs by reducing the size of her IRAs, but we created a pool of tax-free assets that she plans to leave to her kids and never access. They'll have tax-free income over their entire lifetimes. So that was a big success out of a really a painful and demoralizing situation for our client. And that's down to tax planning and tax integration and understanding how those rules intersected with her situation. We also just because we happen to have the tax returns and the original files and everything in our database, we can help clients with the kind of high-touch concierge services that I think they really value, even though they're simple to do. Things like helping out with mortgage financing. It's amazing how much our clients value our ability to simply provide tax returns and tax return materials to mortgage lenders when they need it, rather than having the clients have to come up with those documents. And we're able to walk them through other complicated decision-making in real time. For example, for solo 401ks or for business owners who are trying to understand how to maximize tax-deferred contributions and profit sharing, we hold the information in our hand and we can really help our clients efficiently. I've left maybe the most important for last. If you're not giving tax advice to your clients on the basis of an understanding about their present and future tax posture, you're really only doing part of the job. We spend a lot of time thinking about and talking with our clients about tax-efficient investment approaches, and there's no real cookie-cutter solution. Every client has a different mix of tax-deferred and tax-exempt assets with taxable assets. Every client has different opportunities to create new tax deferral opportunities each year. And the location and the kinds of assets that we have our clients invested in are critically informed by tax decisions. None of this is new to any of you, I'm sure, because in the CFP curriculum and in all of the best practices and best thinking about financial planning, we see these links and interrelationships between the different aspects of the planning process. The point I want to make is that if you have the tax returns in your shop and if you have the tax planning in your shop, you're more likely to be able to systematically do a better job for your clients in these areas. Okay, so now I want to shift from the why. Hopefully you're all convinced. And now the question that's burning in your mind is how? How do I integrate tax planning as a practical matter? What steps do I need to take and what are some of the barriers? So I want to talk about four main areas here. You need to make sure that you have appropriate credentials if necessary. You need to think hard about what kind of service you're going to agree to provide to your clients and how you're going to build that into your practice. I'll talk to you about software and processes, and then I'm going to talk about fees and engagements and how to charge for this service, and some observations about what I think works well and how you can use this as a value driver for your revenue stream as well. Credentialing is a complicated subject, and it's really moving. It's in flux right now. The IRS at the national level has long sought to impose national tax preparation requirements. Even right now in 46 states, it requires more training, education, and credentialing to cut hair than it does to prepare income tax returns. And that's something that makes the IRS very unhappy. Because in their view, this ought to be a regulated profession, and they think that one of the key consequences of that would be better overall tax compliance. Unfortunately for the IRS, in 2014, the Circuit Court of Appeals struck down the registered tax preparer rules and rebuffed the IRS's efforts to impose national standards. And the future of national regulation in this area really remains in limbo. It would require additional statutory authority, the IRS isn't the most popular agency in town right now. It's not at all clear that they're going to get the authority that they need in the near future. So it's up to the states. And the states are moving slowly, but they are moving in the direction of requiring credentialing. So if this is something that you are interested in including as part of your practice, you need to be paying attention to these developments. Because this is a licensure requirement, just like a registered investment advisor ADV filing or SEC filings, just like insurance producer licenses or brokerage licenses, this is a pretty high regulatory obstacle if it applies to you. In 4 states right now, California, Oregon, Maryland, and New York, there are specific education, work experience, and ongoing continuing education requirements imposed on tax preparers. So if you want to prepare a return for a client for money in these states, you need to get a license, and it's going to require some hurdles. There are live efforts that I'm aware of in New Jersey and Illinois as well. And I don't know why we would expect that if these results are successful, we wouldn't see them begin to crop up in other states. In fact, if you look at this list, you see New York, New Jersey, Illinois, and California. We've got some pretty big individual taxpayer populations who are already functioning under this regime. And if you're not in one of these states and you do want to integrate tax preparation into your practice, I would do it with eyes open. Expect that at some point your state is going to come around to this way of thinking too as the model is developed. Even if there's no regulatory credential that you have to attain, it should go without saying, but this requires competence. And so someone in your shop, you or somebody that you engage for the purpose has got to, at a minimum, be competent in the tax preparation task in order for you to be able to provide it. And that's no different from any other service that you provide. Let's talk about service level agreements. In our shop, and for many members of ACP, the service level agreement is that the planner is responsible for tax return preparation and filing, and for all of the tax planning throughout the year that is required in the client's situation. So that's full integration, and it means that all of those tasks are centralized under the main engagement. There are options. People within ACP have devised different ways of doing this, and there's certainly more than one way of achieving this integration. Many people have opted to do third-party preparation. That is, you either have your clients separately engage, or you engage a third-party preparer to actually do the return preparation. A second model is to omit tax return preparation altogether, let your clients take care of that, and focus your attention on integrating tax planning into your engagements. And then, as I mentioned, there's full preparation and planning under the same engagement. Probably the most popular alternative is to do third-party preparation, and this has some challenges. The reason it's popular is either because you live in a state with credential requirements and you don't meet the credential, or because attaining the level of competence that's required to perform the task is more than your practice is willing to invest in, at least for the time being. So in the third party preparation model, the real challenge is to identify practitioners in your community who are willing to work with you on this basis. So you need to find a competent tax return preparer who's got capacity and is looking to work with somebody on a volume of returns. And if you might have 20 clients, you might have 100 clients, and so you need to find somebody who's willing to bite off that kind of chunk. You need to find somebody who's willing to accept your presence in the relationship as well. You need to define the terms of engagement, in other words. There are probably many tax return preparers in your community who would be happy for you to refer them names of people who might hire them to do tax preparation. But when we're talking about integrated services, you're going to have to be a part of that relationship. My friend who is an electrician always tells me that if he's got a big job and the client wants to watch, he charges time and a half. And if the client wants to help, he charges double time. And you're going to be at least watching and probably helping this preparer as he completes his tasks. So that can be a difficult thing to negotiate. In terms of engagement terms, you need to think about who's going to control the client relationship and the billing. Do you want to hire the third-party preparer and have that come out of your fee? Do you want to negotiate a discount or a special rate and have the client engage that person separately? And you need to be very particular about what kinds of services are provided and make sure that the engagement will support the kind of integrated planning that you're looking for. I think this kind of approach requires a lot of attention to regular meetings and communication. It doesn't work if you're not if you are not consistently on top of what the preparer is doing. The last thing you want is to enter into an arrangement like this and then have your clients come back and complain to you that it's April 13th and they haven't heard from the guy. You need to be on top of it if it's going to be going on outside of your shop. And the last thing is I want to say that if there's information that's flowing outside of your shop and into another, you need to pay particular attention to information security. Clients can be very sloppy about this, and I've found that even tax return preparers can be somewhat lax. But whatever else your clients are doing with their personal information, when you have tax returns and tax return information that identifies the client, you're responsible for making sure that it's secure. And it means setting up a rigorous set of protocols and technology that you're satisfied can support this exchange of information between your two shops. And you need to have the client's permission, and you need to have appropriate disclosures in place as well. So the third-party model can be challenging simply because you've got somebody else in the mix. But for some folks, it's the only choice or the best choice to start down this road. The next model is tax planning with no return preparation. You know, I've talked to a number of people who will argue that the return preparation itself really isn't that important. And there's some force to that argument. Once the events in the world have happened, correctly recording them on the document is not really the big value add, and I think there's something to that. And so they say, I'm going to engage in all of the tax planning. I'm not going to worry about the preparation itself. I'm going to assume that that's accurate. So if you want to do that, if you want to incorporate tax planning but without taking the additional step of preparing the returns, you still need to embrace software. You need to be systematic about your approach, and you need the assistance of some pretty powerful software to allow you to do the tax planning part. And you should actively seek out opportunities to show your client what the impact of taxes is in the plan and how you're adding value. Areas that I've already mentioned. Wages and withholding is probably the easiest and best entry point for getting more closely integrated with your client's tax situation. Simply taking a pay stub, projecting out the income and the tax withholding throughout the rest of the year, and making an assessment of whether your clients are on track to meet their tax obligations. That alone can solve a lot of vexing problems in clients' lives and put you more at the center of their planning. Particularly where clients have irregular income, either from commission or periodic bonuses or from self-employment. Making decisions and giving advice about withholding and about estimated taxes is not very time-consuming, not very labor-intensive, but can yield significant results. Having a regular Roth conversion program for all of your clients is also a relatively simple and easily systematized way to add value in your clients' lives. Whether you're focusing exclusively on free two-step conversions throughout your client portfolio, or whether you're taking a deeper look for opportunities to do unusually low cost or low bracket Roth conversions, that can be an important value add. Solo 401ks, we set these up for all of our clients who are eligible to do them, and we are frequently surprised by the experiences of new clients who've been in business for many years and who've not looked at these or not felt that the complexity was justified. And of course, I think probably all aware of the importance of doing tax planning for major liquidity events and dispositions, whether it's a business sale or a large stock option exercise, stock vesting, etc. And then finally, the model that I think best serves clients, and when you can do it, I think best serves your practice and your business as well, full preparation and planning. And this means devoting a chunk of your time each year, or staff time each year, to getting the job done. It does create time constraints, and for mature practices with a larger number of clients, it can eclipse other work for 6 to 8 weeks during the spring. So it's important to recognize that and plan for it. Communicating with clients and organizing this process, just like any other, is the key. You need to gather the information from your clients. You already know from trying to gather asset information from your clients that it's very difficult. Gathering detailed income sources and amounts from your clients is extremely challenging, and it's important that you start early in the year with regular programmed communication so that you can gather that information. You need to prepare the return. Preparing the return is less challenging than you may think it is, but it does require a level of expertise not only in the tax code, but in the particular software that you're using to be able to do accurately and efficiently. And you've got to devise processes to make sure that errors are caught and that deadlines are met. The best part, though, is that now you've got a new meeting in the spring with your clients where you get to deliver the good news. And as I said at the beginning, this becomes a very, very important touch point for us and our clients. Believe it or not, I've had more than one client tell me that we make tax preparation fun and that they look forward to the meeting in the spring. So since I look at coming to financial planning as something like going to the dentist, when our clients tell us that they're enjoying themselves, we know that we're doing something right. I can't emphasize enough that if you bite this off and have not built the processes and capacities to do it, it will make your life miserable. It is a lot of concentrated work in a relatively brief period of time. So seek out within your professional community people who are doing this. Learn about the processes and procedures they use and the tricks they use for making it manageable. Let's talk about fees and engagements. I will tell you that our engagement is an annual flat fee retainer, which means that all of the services that we provide throughout the year, whether it's investment management or tax planning and preparation or retirement planning, all of it's included under a single flat annual fee. So there's no incremental cost or revenue from doing what we do, but we set our fees accordingly. For an AUM engagement, it would be possible to integrate taxes under the AUM fee model. You're going to have to make a decision whether you increase your AUM to accommodate the extra work, or whether this is something that allows you to keep your AUM rates high in the face of competition and fee compression. I think it's also compatible with an hourly or subscription model. Again, the key is pricing. Clients, in my experience, are willing to pay very fair and appropriate levels of fee for service, but you've got to make sure that they understand what it is that you're doing for them and price it appropriately so that you're compensated for your time and effort. Finally, there's standalone. Now, a standalone engagement is the typical way that most tax return preparation is done in this country. It's either done on a flat fee for a simple return, or it might be done based on a fee schedule per tax form and schedule. For CPAs or tax preparers who are migrating into financial planning services, this is a common model for them to retain that revenue model for the tax preparation services as they move into planning. So it's compatible with a wide range of approaches, but you need to think about, before you think about offering the services, what, if any, additional fees you're going to charge and how that's going to be built into your engagement model. So that leaves us about 10 minutes for questions, and I would like to take questions if there are questions. Before I do, I just want to give you a short plug. If you're interested in tax integrated planning, or interested in some of the other things that ACP has to offer, I would invite you to consider coming to the conference in November. The annual conference is a highlight of my year. It's always very energizing and inspiring. It'll be in San Antonio this November 8th through the 11th at a very nice place up in the hills above the city. So with that, let me open it up for questions and see if I can answer them.
All right, everyone, if you have questions, please enter them in the questions box, and I will read them out to Troy. Okay, Troy, our first question is from Michelle Fate, and she's asking, could you review any recommended software options, especially if dealing with equity comp?
It's a great question. There are a variety of kind kind of full-service tax packages that that I'm aware of and that ACP members use regularly. I think probably the most popular tax return preparation and planning software is Lacert by Intuit. Those are the same folks that make TurboTax and also QuickBooks. So they're a familiar company, very reliable. It's the software I use. The planning package is certainly robust enough to handle equity comp, including if you still have incentive stock options in your client experience, the various AMT implications of ISO exercises. The other package that is popular is Drake, and I believe that Drake also has its own onboard integrated tax planning tool set as well. Those are the ones that I see used most frequently for small shops that do full service planning and preparation. There are a number of other tools. B&A has a full suite of tools. And then I've even known some people who use the retail versions of tax software like TurboTax or TaxAct just on a serial basis. But I wouldn't think that those retail versions have the kind of planning capacity that you need. That's not an exclusive list, but those are the ones that I'm familiar with.
I got a few follow-up questions about software. Kurt Box is asking, and you might have touched on this, what kind of software integrates with the planning software or preparation software, and does it show the client the long-term benefit of tax planning in a tangible way?
So Drake and Lacert both integrate, and what that means is that you can automatically populate the planning the planning package with data from the prior year tax return. So you don't need to input the starting assumptions, as it were, and then you can modify that. Prior year's return either by escalating the income or the deductions on a percentage basis, or you can create manually changed scenarios. But for example, if you're trying to understand what the impact would be of different stock option exercise patterns, you can create 7 different scenarios and change only the stock option exercise. So those two are integrated. In terms of output, there's nothing in those software that is super fancy about showing the benefit of planning in a tangible way in the planning software, other than to show them the scenario, and you can kind of point to the different tax outcomes and show them the difference. With Lacert, which is the one I'm most familiar with, on the preparation side, there is an extensive analyzer that sort of automatically says to your client, this is the dollar value of the planning that you engaged in, for example, because you contributed to your 401k, you saved an estimated X dollars. If you increased your contributions next year, you would save Y more dollars. I don't find those to be especially compelling to clients, but there is that functionality. I don't think that it's been rolled out in an especially shiny way.
Okay, our next question comes from Brett Layton, and he asks, do you have a stable of compliance people?
Do I have a stable of compliance people? Well, I have a lawyer his name is John Carr. He's terrific. I've been working with him since I started in the field. He advises about state investment regulatory agency compliance, as well as general business counseling. I think implicit in the question is what kind of compliance advice do you need if you're going to be doing tax work on top of what you already need for compliance in the regular investment advice and financial planning fields? And the answer, I think, first of all, is that it depends on the state that you live in. So if you're in an unregulated state, I think the answer may be that you don't need a lot of extra compliance work. You'll need to make sure that your fee arrangements, as modified for the tax part of your engagement, pass muster. Some states don't like that. For example, in my case, that the single fee integrates all the services. They're not very happy about that, and so you may need to figure out a way in your particular jurisdiction to break those things out. And then if you live in a state that does have compliance rules, the 4 that I mentioned, then you'd need advice on that. But I would start with the folks that you use to do your compliance more generally, and see what they can offer.
All right, and Brett also had a follow-up asking about tax compliance and return preparers.
And
what
what
have go to people for that as well.
I hear the follow-up. I'm not sure I understand what the question is, though. I don't have separate compliance. I don't have any separate compliance associated with the tax part of the practice.
All right, so our next question is from George Middleton, and he says, I thought AUM was not part of your model for ACP. Is that an option?
Well, ACP is very ecumenical. There's no requirements about fee model. The basic fee model within ACP is a flat annual retainer. And we think there are many advantages to it. Not everybody within ACP has that as their exclusive revenue stream. There are many advisors within ACP who take a part, or in some cases even all of their revenue as AUM. So it's certainly an option. We don't prescribe fee models.
Okay, so the next question is from Ken Zimmer, and he's wondering, how do you set your flat fee annual planning fees? Is there a range based upon complexity?
There is. That's a good question. Actually, for more detailed information, you ought to contact ACP, because I think that some of this information is publicly available. But I'll just describe, in general terms, the way that our fee is set. We've got 3 factors. It's the household income, the household, I'll say net worth. It's not exactly net worth, but that's the concept. And then complexity. And the primary drivers of complexity are the complexity of the income tax posture. How many different sources of income are there, and how much revenue is being driven from each of those sources, and how complicated do we think that the return preparation and the tax planning function will be, and what are the opportunities that are associated with it. The idea is to create a fee that is value-driven and that allows the client to take more value from the engagement than we're charging them in fees. That's a somewhat abstract standard. It's subjective. It's ultimately up to the client to decide whether that's true or not, but that's what we're striving for.
Okay, and the next question is from Jared Houle. And he said, you mentioned a systematic approach to Roth conversions. Could you speak more as to how your firm handles these?
Yeah, as part of the tax preparation process in the spring, we'll track for every client and for each member of the couple, if they're a married couple, what the posture of their Roth conversion opportunity is. So what that basically comes down to is do they have a blank slate when it comes to IRA holdings? And if they do, and they're not eligible to make direct Roth contributions, then we will have them make traditional IRA contributions up to the max each year, and then convert them to Roth IRA in the subsequent year. For clients who do have existing IRAs that would affect the denominator and the numerator of the conversion, we make an assessment for the particular year whether if they make a conversion, they'll be in an unusually low tax bracket. Or if they, for some reason, have ordinary losses to absorb, so that they can do what we call a low versus a no cost conversion. So we put that on an annual cycle. It's in our CRM for each client, and we keep track of that from year to year. Once you identify within your client base who is in what posture, it's relatively stable from year to year. There are changes, but for the most part, clients who are doing two-step Roth conversions are doing them every year. Clients who are, for some reason, ineligible to do that free two-step Roth conversion, we would evaluate on a case-by-case basis depending on the income tax posture for the year.
All right, and then we have a question from Phil Putney, and his question is, what financial planning software do you use to accurately reflect future retirement tax costs?
We don't use financial planning software, but we do estimate tax costs in retirement based on the tax planning software that we're using. So what we will do is to model based on the existing tax code and based on the client's existing, I'll say, ratios of traditional type holdings to Roth type holdings to taxable holdings to real estate, what sources of income they're likely to be drawing in retirement. Typically, we produce a blended rate, and we're pretty heavy-handed with it. That is, we try to overestimate that rate. In fact, in retirement, we're making annual decisions about the sources of income, and we're trying to minimize it within the year and over time.
Right, and the next question is also from Phil, and he asks, what is your fee structure?
So I've just described this in terms of the approach. It's a flat annual fee. It's based on the three factors I mentioned: income, net worth, and complexity. Our fee begins, that is, we have a floor of $2,000 a year and a ceiling of $50,000 a year. We have that floor and the ceiling because we feel like we should, and we were encouraged to, but I will tell you that those don't really restrict us very much because we don't have very many people anywhere near the floor or anywhere near the ceiling. Most of our clients pay us between $6,000 and $10,000 a year. We have some that are outside of those parameters, but that's a pretty good indication of where we are. I think our average is 8. We're in the 8s.
All right, and we have the next question is from Gian Stapleton. If you do not have any accounting credentials, what training or other steps would you recommend to help reduce potential liabilities?
Well, so this is a good question. It used to be, and this is now probably a decade ago, that I think the best advice would have been to go and take an H&R Block tax course. That might sound a little bit low rent, but it was comprehensive, and I think it probably got people a good base. The National Association of Tax Preparers has a great set of programs for annual CE. I do a lot of my required CE for my bar license and also for my CFP, concentrating in the tax area to stay current. But I think actually ACP would have a better listing of programs and credentialing sources for you if you were to contact them. I'm in a little bit of an unusual posture myself, just because of my background and my history and the way I came into this. So I'm not gonna try and tell you too much about the initial training programs. But what I would say is this. Tax is like any other aspect of financial planning. The fiduciary standard requires competency, and our obligations to our clients require competency. So the fact that this requires additional work, I don't think distinguishes it from any other area of planning, whether it's college planning or gift planning or working with widows. Or working with state employees or university professors. Every client need requires expertise, and this is just another client need that requires expertise.
Okay, and we also have a question from Lucas Zabalski, and I apologize if I butchered your last name, Lucas, but his question is, how do we make sure as financial planners that we don't cross the line and provide specific financial advice without holding the CPA title?
So let me take that question apart a little bit, because I think that it reflects a bit of a misconception about what CPAs do and what's required in the tax field. So a CPA, a certified public accountant, is allowed to do one thing or one cluster of things that other people aren't allowed to do, and that is to review the books of an organization, a business organization or a nonprofit, and attest to the world in general that those books are accurate and fairly represent the results of the business operations. So that attest function is what the certified and a certified public accountant means. You don't have to be a CPA to prepare taxes or to give tax advice. Even in the states where a credential is required, you don't have to be a CPA. You have to have a different and special license to do tax return preparation. So giving people tax advice is not confined to CPAs or to tax lawyers or to enrolled agents. And the other thing that those three categories have in common is that those three categories, CPAs, attorneys, and enrolled agents, are allowed to practice in front of the IRS. If you don't hold one of those credentials, then you're not allowed to represent taxpayers in front of the IRS. There's some other exceptions, but none of those have to do with your ability to prepare tax returns or to give tax advice. And most tax return preparers do not have any of those credentials. I'm not saying it's not a good idea, and certainly with special training and skills comes real value. So don't misunderstand me. I'm not discounting the value of a CPA education and training program or credential, but if it's something that you're considering, this is not like some of the other areas in financial planning where if you do too much, you're running into a different regulatory regime like insurance sales. At least for now, outside those 4 states, there really isn't that much of a barrier.
Okay, and we also have a question from Michelle Morris. She asked, do you recommend doing a small Roth conversion for everybody, even if it's high cost, just to get the 5-year clock ticking?
Oh, that's a good question. Sure. You know, I hadn't thought of that, Michelle, but that's an excellent idea, particularly when clients are a little older and getting closer to retirement. If they don't have any conversion or anything in a Roth, I think that's a really good idea. That's a small toll charge to pay.
Michelle says that it's actually Natalie Choate's idea.
Well, then it's definitely a good idea. She's a great resource.
All right, and we also have a question. This is our last question in the series before I move on to comments, so if anyone else has any questions, be sure to submit them. But we have a question from Brett Layton, and he's asking if the EA should be obtained if no JD or CPA.
So again, the EA is a great training program, and I think it's a great credential to have behind your name when you're holding yourself out as a tax professional. Yes, but I want to emphasize again that the only time you need that credential is if you want to represent your client in front of the IRS, either in an audit or in an administrative proceeding. Now, if you just want to represent your client in a correspondence audit, you can get a power of attorney as the preparer to provide information to the IRS and to communicate with the agency on behalf of your client. But if there's a real audit and you're representing your client, you would need to have one of those designations. So, and this kind of gets into another area, which is, are you going to provide audit defense for your clients? We do, but not everybody does. And so if you're not an EA, CPA, or an attorney, know that you're not in a position to take your client all the way through the administrative process within the IRS, and so you'd have to modify your commitment accordingly. But I think it's a great way to get the knowledge and competence that's required to perform the task.
Okay, and it looks like we are at the end of the questions, but we do have a couple of comments from ACP members. On the subject of software, Wendy Marsden says that she likes Pro Series, and it's actually much more similar to TurboTax. And we also have a comment from Pamela Kenda, who says that Maryland has a de minimis allowance of 5 paid returns.
That's great, Wendy and Pamela. Thanks for filling in those gaps. I didn't know that about Maryland.
Okay, so if there are any final questions, please put them in the chat box. I will ask Troy. All right, Troy, it looks like there are no further questions. So I would like to say thank you to Troy for your time, and thank you to everyone for attending. You will receive a follow-up email with information on CEs, the white paper, and the recording of this webinar. So thanks again, Troy. Thanks again, everyone who attended, and everyone have a great afternoon.